Welcome to the Daily Update, where I'll go over the action in the market for Friday, February 16th, and then we'll see how things look for Tuesday, February 20th. The markets will be closed on Monday, February 19th, in observance of President's Day. Well, not much really happened in Friday's session. We closed right around the 5,000 level. Haven't seen a real change, at least yet, in the technical picture. We are looking positive when we take everything together. We're somewhat overbought, so we're looking a little overextended to the upside, but we've been that way for most of 2024. We're entering what could be a period of weak seasonality. We'll have to see if that comes into fruition. And we just kind of want to see the story unfold each day, because even though not much happened in Friday's session, we still have an adjustment to some of our charts that I'll go through. So let's go back and talk about what happened. Right at the open, we had a lower open. The PPI report came in stronger than expected, and the futures were already a bit negative. Then they switched to even more negative as the report was being digested. So that led to the lower open, and we fell down below the daily pivot at 5,021. We also fell below S1 at 5,009. We found support at 5,000. Gee, do you think that's an important level? Now, for the most part, 5,000 is psychologically important, but now that we're using this as either support or resistance, it's becoming more of a technical level as well. As the day went on, we rebounded back above S1. We got above the daily pivot. We tried to go positive and get above the unchanged level, and then we fell back to the daily pivot. Prices then went back above the unchanged level, but we didn't get up to R1 at 5,042. Then we fell back below the unchanged level, the daily pivot, S1, and then we closed slightly above 5,000. So it was a pretty choppy day altogether. We were down 0.48% on below average volume, which is strange because it was the third Friday of the month. This is options expiration, and a lot of times we see a real pickup in volume on that day. We didn't see that in Friday's session. We are positive with our technicals. As I said, we're looking still overbought, and we're still looking positive to this point, but we could be entering that period of weak seasonality. In Friday's session, it was also about inflation and interest rates, and the market reacted negatively to the PPI since it was stronger than expected. Of course, we want to keep an eye on all the different geopolitical events. Some comments: the PPI was stronger than expected, and I'll show you some charts there. Our list is not really long when it comes to what's overextended to the upside in the short term. We have the CCI 20 and the stochastics. In the intermediate term, a little bit longer, we have the NASDAQ 100 bullish percent index, which is still above 70. Our oscillators are still looking extreme, and those are slower. Even the short-term oscillators can take some time to adjust, and the Sean trend meter. Long-term, we're still above the 150 and 200-day moving averages there. So we're looking not really overextended to the upside, but we're still looking extreme positive in some areas. The parabolic SAR chart continues to be negative, though. The dot is still on top. Personally, I think that's a pretty important signal. And as long as we're on top, there's the threat of more weakness coming into the market. We're still kind of working through this basic scenario that it looks like the Fed is pretty much done raising rates. Now the big question is, how long are they going to keep them where they're at right now? Are they going to start cutting rates at some point into the future? It was looking like March. That was taken off the table this past week. Pretty much May was taken off the table. So now the market's having to look a little further out. The dollar was down and interest rates were up. We're getting to 4.3% with the 10-year yield. That was putting some pressure on stocks. And we still have the yield curves that we've been following that are still inverted. Sentiment is extreme. We're above that 75 level. We were unchanged from 77 on Thursday to 77 on Friday, but that's getting up to that extreme level. Now, we hit this level before, we saw a decline, and we started to come down. We've been going back up with sentiment as the market has been improving, so there's a bit of a different context there. We are positive with our trend, but the ADX charts are showing that they're dropping below their moving averages. So even though it's above 20, which suggests we're in a trending environment, it's possibly a weakening trend. And I should have changed this. The bias should be negative with the down day and the momentum. I'm still keeping it mixed to positive for right now. We had that solid down day on Tuesday, and then we spent Wednesday and Thursday coming back, and then we were a little bit down on Friday. So I'd probably lean more towards the mixed category right now. The reports that came out, we had housing starts, which came in at 1.331 million, less than the 1.47 million they had expected, and down from the 1.562 million that we saw last time. Building permits were also weaker than expected at 1.47. They expected it to come in at 1.51 million. Last time it was at 1.493 million. These tend to be leading indicators, and the fact that they're falling off a little bit is suggesting some economic weakness going forward. The PPI came in a lot stronger than expected. They expected it to be up 0.1%. It was up 0.3%. Last time it was down 0.1%. The core PPI, and this is more the inflation area, it was a lot stronger than expected too. It came in up 0.5%. They expected it to be up 0.1%. Last time it was down 0.1%. Consumer sentiment came in at 79.6. They expected it to come in at 79.3. Last time it was at 79. Here's a chart showing a 3-month average of housing starts and building permits. The starts are in blue, where they're tapering off a bit, and the building permits are in yellow, and they're also tapering off as well. Here is the final demand for PPI on a year-over-year basis. The total is the blue line, and that's pretty much flat, where we're seeing a little bit of a turn up now with the core PPI. Here's looking on a year-over-year basis, again, where we're seeing a decline with goods, and we're seeing an increase here with services. And then intermediate goods, processed and unprocessed. The blue is the processed goods. That declined a little bit. We actually showed a bit of an increase with the unprocessed goods year over year. Here's our chart that we look at, where we're still kind of flattening out when we go on a year-over-year basis, but we are starting to go back up when we look at a month-over-month chart. Then when we look at the rate of change, that's continuing to decline, but we did come back up in the latest reading when we look at the month-over-month version of this chart. Here's what they post on briefing.com. The total is the blue line, where that is going up for consumer sentiment, and it's still going a little bit higher, where the expectations are still looking good, but people aren't feeling quite as good now with the purple line. It ticked down a little bit. And here's our chart showing how consumer sentiment has been improving. That's the blue line. And interest rates have been coming down, but this past week they've been going back up. We're still seeing a pretty wide spread between the red line and the blue line, even though they are getting a little closer to each other. Couple of charts here. These are earnings revisions, and this is the breadth. They're just kind of trying to shoot the middle on this to see, are we more positive or are we more negative? We're still negative, but we are showing some improvement as the earnings revisions are showing a little bit of an improvement across the board here. And then this is advanced real retail sales. Real means it takes inflation into account and food services. We're still topping out and pretty much going sideways here. Now, other times when we flattened out, that will often be before we see a recession. So other than just seeing this is flattening out, we don't have a lot of evidence yet from this chart that we may be heading into a recession. Here's our intraday chart. We did have a lower open. We went down below the daily pivot. We went down below S1. We did hit support right at 5,000. And being options expiration, there were probably a ton of option contracts, both calls and puts, right at 5,000, and people that either bought or sold those options. And we bounced up off of that, came back above the daily pivot, actually went positive for a little while, then drifted back down to the daily pivot. Then we went back positive again. We didn't get up to R1, and then we saw some more weakness later in the day where we dropped down below the daily pivot. We came down below S1, right down to this 5,000 level, and closed just a little bit above 5,000. Here's our intraday chart. Not an awful lot of change in the initial overnight session. We did see some strength in the futures, and then the PPI came out, and that sent everything negative. Here's the choppiness in Friday's session, and we're trailing off just a little bit as the market closes for the 3-day weekend. We did see where both growth and value were down. The red line and the blue line did decline, but the red line is still on top. That means growth is outperforming. So now we're seeing another day where growth has been underperforming. We saw that in Thursday's session. Now we also saw that in Friday's session. We want to see this turn and go back up. It's not falling apart necessarily. Of course, this drop off didn't really help in Thursday's session, and we were negative on Friday. But eventually, to turn more positive, we want to see this going back up. Our end of day charts, we were down with growth and value, but growth was down more. Also for the mid caps, growth was down more, and also for the small caps. And we did decline a little bit with our small cap growth versus value ratio, but still overall, it has been showing a lot of improvement, but we're not really seeing much of a breakout yet with the index. And we did decline with the mid cap growth to value ratio here. We're seeing more of a sustained uptrend, and we're seeing a little bit more of a potential breakout with the mid caps. They're looking a little stronger right now than the small caps. And we did decline with our S&P growth to value ratio, but overall it has been advancing. As long as we can stay above these two lines, we may see a golden cross with this ratio. And we're hanging in there okay. We saw some recent strength here when we look at discretionary versus staples. It declined in Friday's session, but we had been seeing a more pronounced negative divergence where now this is starting to show some improvement. We want to see this turn and go back up if we're going to be more positive with this. Here's our trend where we're still below the moving average. The green line's on top, even though it did decline. We're also below the moving average with our short term, and the green line also declined. But we would still default to positive because the green line is on top with both charts. We have been tapering off with volume over the last number of days. The only above average volume day that we saw was when we saw the big down move in Tuesday's session. Here's sentiment, not really showing much of a change with the Ulcer Index. We ticked back up a little bit with the VIX on the line chart as well as the bar chart, and we're above the moving averages with both. And the VIX of the VIX actually declined a little bit with the bar chart as well as the line chart here, and they're below the moving averages. We did decline with the equity put call ratio, but we're starting to turn back up ever so slightly. It's probably really hard to see, but we're ticking back up with our 5-period equity put call moving average. And we're still getting a pretty extreme reading here with our VIX to S&P 500 correlation. We're still above this dashed line. When this tops out and comes down, quite often that is negative for the market based on what has happened in the past. And we're still looking pretty extreme here with the skew index. Even though we're starting to drop down out of the red area, we're wondering, is that going to be a positive move or a negative move? We might default more to the negative side because of what we're seeing back here with the correlation chart. So this is no longer extreme, but it hasn't really told us what it's going to do, at least yet. And then I showed this before. This is also suggesting that the investor's intelligence is showing that we're extreme positive. This comes out every week, and that's why I show this chart often more than one day at a time. I did bring this up in the video for Friday. I just want to point this out again in case you didn't see that video. There's a thing out there called the Hindenburg Omen, and it's based on some research, and a lot of the perma bears really pick up on this. I'm not a big believer in this, but my warning to you is you're going to be presented this, if you listen to some of those folks, as though this is like a done deal. This is, put a knife in it, we're finished here with the market. Where really, when you look at the track record over a period of time, it's only right about 25% of the time. Over here on the left-hand side, this talks about how it's calculated. And pretty much the conclusion that Investopedia has come up with is the conclusion that I have is you shouldn't use this in isolation. I don't have charts to show you this because I don't see where it's all that valuable. But just be aware of that. It may end up happening. It may be part of the 25% of the time, since we're entering this weak seasonal time where this actually comes through. But to base everything on something that has such a low percentage of success, in my opinion, is kind of a dangerous thing to do. Then we look at the advanced decline line studies where we're declining just a little bit based on price, but we're still hanging in there. We declined a little bit more, but we're also looking positive based on volume. We did see more new highs than new lows. We're starting to turn back up, but we haven't crossed above the moving average with our 5 period, and we're starting to go back up with the 10 period. We're still positive with the advanced decline ratio. We're above 0. Accumulation distribution did come down a little bit, but we're still above an advancing moving average. We declined with the Chaikin money flow, and the moving average is turning down, but we're still looking positive for right now here. And we came down a bit with the Chaikin oscillator. We're no longer extreme positive. With our advanced decline line studies, we came down with the common stock on the NYSE, a little bit of a decline with the S&P, mid caps, and small caps, but nothing all that pronounced at this point. Here's our daily chart where we're still above this upward sloping trend line. I have another breakout chart to show you. And then on the bottom, even though it was options expiration, we were below average with volume there. We ticked down a little bit with the 20 and 50 and just a little bit lower with the 200-day moving average study. We're still extreme positive with the CCI 20. And the force index is still below the midpoint, but it's green, so that's positive, but not real positive. It would be more positive if it could get back above the midpoint and see the midpoint turn back up. We're coming back down and not quite extreme in the short term with our stochastics chart. We're back to looking extreme in the intermediate term, and we remain extreme positive, even though we're declining in the long short term with our stochastics charts. And we're no longer extreme with our standard deviations chart. We were right on the border between the +2 and +3 channel. Now we're coming back down into the +2 channel. Intermediate term, we're still looking okay with the balance of power, even though it declined. We're still positive with the go, no-go system with the darker blue bars. And we're still above the midpoint with our highest high value. The TTM squeeze is now turning back over to the darker blue. So it's positive, but this is more with a negative bias. We're turning back down a little bit with the ease of movement, but we're still above 0. We're flat with the Erin indicator after being extreme positive. And we're right on the line here with the McClellan oscillator for the S&P. If we're above 0, that means the summation index is positive. If we drop below 0, that means the summation index turns negative. So we're kind of going a little bit higher right now with the summation index based on price. We're also ticking up just a little bit based on volume, but it's pretty choppy right now where this thing tends to move one direction or the other. We're seeing some indecisiveness right now. We did decline with the NYSE McClellan oscillator, but we're still above 0. So we're continuing to go up with the summation index for the NYSE based on price and volume. And we declined with the Swenlin trading oscillator, but we're still above 0 based on price and volume. And we're still kind of seeing some mixed signals here with the PMO. We're starting to drop below the moving average, and we're extreme positive with the PMO itself. We are starting to cross back above the moving average based on price. We're right on top of the moving average based on volume. So some contradiction here. We were down just a little bit with the PMOs that are rising. The buy signals are starting to go back up, and we're seeing a little bit of a turn up with the PMOs that are above 0. And we have switched from being positive to neutral for the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR since the dots are on top. We're rolling over below the moving average and still extreme positive with the slope oscillator. We're right on top of the moving average with the MACD. So looking at all of this, not only are we dropping below the moving averages, you could now start to make a case for longer-term negative divergences where we didn't come back up to the previous high. And I like to point this out. These oscillators are moving average based, so you can't help but see a negative divergence in some of these calculations. It's not so much that the indicator is telling us what's happening. It's because the numbers are being calculated, and you have lots of people that are seeing this, and it ends up being a self-fulfilling prophecy. But we are pretty much flat now with the MACD. We're flat with the PMO. We're dropping a little bit below the moving average with the PPO. We're rolling over just a little bit. It's still slightly above the moving average with the TRIX, and we're right on top of the moving average with the KST. We're still above all of the moving averages here plotted in the moving average tree. We did turn up a little bit. This is somewhat encouraging. The bullish percent index did go up. Now, we had topped out and we're starting to come down. The last couple of days, we've seen this start to go back up, and it's not necessarily extreme positive at this point. We did turn up a bit here with the NYSE bullish percent index, and we're flat with the NASDAQ 100 bullish percent index, but we are above 70. So we are extreme positive there. We continue to decline after being extreme positive with the money flow index. We're also declining, but still positive with the ultimate oscillator. We were flat to slightly declining with the vortex, but the green line is on top. We're declining with the RSI based on 14 as well as 9 periods, but we're still above 50 with both, so that's positive. Even though we decline with on-balance volume, we're still above an advancing moving average. And we tick down a little bit with our 200-period moving average study for those stocks inside the S&P, and we're seeing a longer-term negative divergence here. We tick down with our 50-period moving average study, and we're seeing a more pronounced negative divergence here when you compare the movement of these indicators with what was happening with the S&P. We're still below the moving average with the Copic curve, and we're no longer extreme positive with the Sean trend meter, but we're still looking fairly positive there. With our charts, we're still looking okay with the Heiken Ashi with our chart variation, the first chart that we look at. We're still pointing up with the Kegi chart, so that's positive. The Renko is redrawn yet again and is looking positive, and we're still positive with the 3-line break. So we haven't really seen any changes there. If anything, it's switched back to looking more on the positive side. Here's our longer-term trend line going from the October 2023 low. We did hit this point a few times this past week. This is a line of support that we're watching. If we start to see some weakness here, we're going to be seeing, are we going to end up closing below this trend line? And here's our 150 and 200 period moving average study. We're still extreme positive there. And this isn't really telling us anything right now. This is a newer fib chart going from the October low to the all-time high. And if we do see some real retracement here, we'll be watching these different fib levels. Looking at our other indexes, no changes in the Keller market model. We're still positive across the board with the S&P, mid caps, small caps, and NASDAQ 100. Here are the different alerts that were triggered. Most of them were positive. They're blue or green here. We had a couple that were negative when they applied to the NASDAQ. And we have Canada setting a new 52-week high. And the equal weight and the regular S&P 500 are pretty much performing about the same. We saw the equal weight outperform slightly, so we came down just a little bit with our ratio between the two. The Dow is still having a hard time getting above this R1 level. We can break above it. We did earlier on, but we can't seem to close above this resistance level. And we've gone from being positive over to neutral with the diamonds for the Elder's Impulse system. We came down with the NASDAQ, but we're still above this R1 level. We'll be watching to see if we close below that as we go forward. We did come down below this R1 level with the NASDAQ 100, so that support level has not held to this point. And we continue to be neutral with the QQQs when looking at the Elder's Impulse system. On a momentum basis, we're continuing to be more negative as the PPO continues to drop below its moving average. And we came back down below this R1 level. We closed right at this point in Thursday's session. We closed down below it, but so far we're not seeing any major weakness to the downside. We're still above the 50-period moving average. And we still remain positive with the small caps when looking at the Elder's Impulse system. We're still above this resistance level, which the longer we stay above this, and if we come back down, this may end up providing support. We're still above 50, although we're declining with the RSI. We're still in a longer-term uptrend, and we're still looking positive with the momentum here. And all of this is based around the Russell 2000 small cap ETF. The mid caps did come back down and close below this pivot point. And we switched back over to neutral with the mid caps when looking at the Elder's Impulse system. We were down over 1% with the FANG index, but we're still pretty close to the all-time highs. The financial sector was also down, but still is in a longer-term uptrend. And we're keeping an eye on New York Community Bank. It was down 0.61% after it's trying to stage some kind of a bounce after just getting really hammered earlier on. The dollar closed down just a little bit, but we're still above both of the moving averages here. If we can stay above this, we might see a golden cross. Keeping an eye on bonds where we were up with the 10-year yield. We were down with the 10-year based on price, and we're coming back down closer to the 200-day moving average. And then looking at our growth to value, we actually saw some weakness when we look at the Qs to S&P. We're dropping below the moving average. Saw a little bit of an improvement with discretionary to the S&P, but we're still below a declining moving average. We also are coming back down to the moving average when we compare large cap growth to large cap value. So when we look across the board, a little bit of weakness with the large caps, mid caps, and small caps, even though the small caps have been doing better lately. We're still positive when we look at the 5-period moving average of the highs minus the lows and spread that across the broad market. So what's our outlook for Tuesday? The markets will be closed on Monday in observance of President's Day. We're still positive. We're slightly overbought yet again, and we're wondering, is this week's seasonality going to start to come into the picture? And then we're going to have the LEI in Tuesday's session. That's the leading economic index or indicator. And we want to keep an eye on the geopolitical events, especially over a 3-day weekend, to see if something's going to escalate that could have some impact on the markets. And then we have kind of a light economic calendar coming up for the week. We just have the LEI on Tuesday. We're going to get the FOMC meeting minutes on Wednesday. That'll be at 2 p.m. Eastern. Then we're getting not much in Thursday's session beyond weekly jobless claims, and we're not going to have any economic reports on Friday. Seasonality. Looking at February 20th, we're negative across the board. This is also the first trading day after options expiration. We're coming into the week after now where we tend to be down more than up. We tended to have a positive bias in the week of options expiration. Now we tend to have more of a negative bias. And this, according to Carson, shows that from the middle to latter part of February tends to show some seasonal weakness. We're also seeing some seasonal weakness when we look at this other chart. We also see some seasonal weakness with the Stock Traders Almanac chart. Also, when we look at when the sitting president is running for re-election. So we're seeing a lot of confirmation of negative seasonality here. February is the worst of the best 6 months. Tuesday tends to be, at least according to 2023, it's a down day. It's not down as much as Wednesday, but it was negative over the last year. And we'll be on the 13th trading day of the month, where actually in this chart, we actually see some positive seasonality. And then according to Tom Bowley's research, we're entering that period of time now, from now until the end of the month, where we tend to be more negative. So our scenarios, not going with the down one yet. We're still looking positive with our charts, but that could switch if we really start to see some weakness. We still go with the upside, even though logic may go against that, but our charts are still looking more positive. We're not going with the sideways trend for right now, even though we are in a weakening trending environment. However, we're still in a trending environment with the green line on top. So the warning signs. The days when we've been going up, that's when we're seeing a decrease in volume, and that is usually not a good sign. The risk on posture has just not been helping us. The equity put call ratio based on 5 periods, it's now starting to tick back up where it had been going down. Our oscillators are extreme positive. They're dropping below their moving averages, and we're starting to see some negative divergences develop there. The McClellan oscillators and summation indexes, even though some of them have been improving, we're still seeing a longer-term negative divergence. The parabolic SAR chart is negative. The Copic curve is negative. The NASDAQ 100 bullish percent index is back above 70, which means it's extreme positive. And the momentum for the NASDAQ 100 is weakening. We dropped below the moving average. Small and mid caps, when you just look at their indexes, are negatively diverging from the S&P. The discretionary sector, it's showing some improvement, but we're still seeing that negative divergence from the S&P. The transports, which I'm not showing the charts, I'll show those over the weekend when I do the other videos. We're still seeing a negative divergence, not only with the Dow, but also with the S&P 500. And then we are entering a potential period of historical weakness. Positive signs. For right now, growth is holding up. Even though it did show a little bit of weakness in Friday's session, our oscillators are extreme positive, and they're starting to drop more below their moving averages. The vortex continues to be positive. Small and mid-cap growth, even though it declined on Friday, it has been doing pretty well lately. The financial sector is positive. So our conclusion, we're positive, we're slightly overbought yet again, and we're wondering if this weak seasonality is going to come into the picture. That's what we're watching at first in the short term. We'll see if that bleeds over into the intermediate term. We're still positive in the long term, but we're extreme positive since our 150 and 200-day moving averages are extreme positive. Thank you. I really hope you found this helpful. I hope you have a great weekend. I will be posting the other videos, the weekly video, the intermarket analysis video, and the deep dive video. And I have an extra day to do that, so I might post them a little later than usual. Have a great weekend, and I will talk to you in the next video.